Today I'll show you how to calculate the payment per term for an annuity loan. Let's break it down step by step. The formula for calculating the payment is simple. It's PMT equals P times R divided by 1 minus 1 plus R to the power of negative n, where P is the principal or loan amount, R is the interest rate per term, and N is the number of payments you'll make. This is typically in years but could also be in months, days, weeks, or whatever. Let's go through an example. Suppose you've borrowed $10,000, your monthly interest rate is 0.5%, and you plan to pay off the loan in 24 months. We plug the value into the formula like this. PMT equals 10,000 times 0.005 divided by 1 minus 1 plus 0.005 to the power of negative 24. After doing the math, your monthly payment comes out to about $438.71. Remember, with annuity loans, the payment remains the same every term, but the portion going toward interest and principal changes over time. And that's how you calculate the payment for an annuity loan. If you found this helpful, give the video a thumbs up and don't forget to subscribe for more finance tips.